At 9:30 on the morning of August 1st, 2012, the United States stock market opened for another ordinary trading day. 45 minutes later, one of Wall Street's most important trading firms had lost more than $460 million. There had been no market crash, no employee had stolen the money, no hacker had broken into the company. The disaster began with a software deployment that reached 7 servers, but missed the 8th. Knight Capital was not a small company experimenting from a back room. It was one of the largest market-making firms in the United States, helping connect buyers and sellers across the stock market. During 2011 and 2012, Knight's trading represented approximately 10% of all listed United States equity trading. Its computers operated at a speed no human trader could match. That speed was its greatest advantage. On August 1st, it became the reason the company could not stop losing money. The trouble began several days earlier. The New York Stock Exchange was preparing to launch a new retail liquidity program. To participate, Knight needed to update one of its automated trading systems. The system was called SMARS. SMARS received large customer instructions, known as parent orders. It then divided them into smaller child orders and sent those orders to different trading venues for execution. The basic idea was simple. A customer might ask Knight to buy 10,000 shares. SMARS could break that instruction into smaller pieces, search the market, and stop when the full quantity had been purchased. But buried inside the system was an old function called PowerPeg. Knight had stopped using PowerPeg years earlier. The code had never been completely removed. Worse, an important part of the old function had been moved during an earlier software change and had not been retested. That part was supposed to count how many shares had already been executed. Without it, PowerPeg could continue sending orders even after the customer's original request had been completely filled. The function was broken, unused, and still present inside a system connected directly to the stock market. For the new retail liquidity program, Knight reused a software flag that had once activated PowerPeg. The plan was to replace the old code with the new functionality across all 8 SMARS servers. Beginning on July 27th, technicians installed the new software in stages. 7 servers received the update correctly. 1 server did not. There was no required second technician checking that all 8 machines contained the same version. There was no written deployment procedure requiring someone to verify the installation. The 8th server entered August 1st, still running the old defective PowerPeg code. The danger announced itself before the market even opened. Beginning at approximately 8:01 in the morning, Knight's internal systems generated automated emails containing an error message, PowerPeg disabled. 97 of these messages were sent before 9:30. But Knight had not designed these emails as formal system alerts. Personnel generally did not review them as urgent warnings. The messages arrived. The system was trying to say that something was wrong. Nobody acted before the market opened. At 9:30, customer orders began entering SMARS. 7 servers handled them correctly. When an order reached the 8th server, the reused software flag activated PowerPeg instead of the new retail liquidity program. The defective code began creating child orders. Normally, the system should have counted each completed trade and stopped when the parent order was filled, but the 8th server no longer knew when to stop. Imagine giving a computerized cashier an instruction to buy 100 shares. The cashier buys 100, but never records that the job is finished, so it buys another 100, then another, and another. It continues until someone disconnects it. That was happening at electronic speed, across multiple stocks, inside one of Wall Street's most active firms. Another part of Knight's system could see that the original customer orders had been completed. But that information was not successfully communicated to SMARS. The router continued sending orders as if nothing had been filled. Only 212 incoming parent orders triggered the defective code. From those orders came millions of child orders and approximately 4 million executions. In roughly 45 minutes, Knight traded more than 397 million shares across 154 stocks. The company accidentally built enormous market positions. It became approximately $3.5 billion long in 80 stocks, meaning it had bought billions of dollars more shares than intended. At the same time, it became approximately $3.15 billion short in 74 other stocks, meaning it had sold billions of dollars in shares it did not intend to sell. The computer was not merely producing incorrect information on a screen. It was sending real orders into real markets and receiving real shares in return. The erroneous activity also moved prices. In dozens of stocks, Knight's executions represented a large portion of the total trading volume. Some prices moved by more than 10%, while the defective system continued buying and selling. Inside Knight, employees could see that something was seriously wrong. A monitoring account began filling with unexplained positions. Senior personnel watched enormous numbers accumulate. But the monitoring system was not connected to an automatic shutdown. It could display danger. It could not stop it. The account had a gross position limit of $2 million, but that limit was not linked to an automated control capable of blocking further orders. The company also lacked a firm-wide capital threshold that would automatically disconnect its systems when exposure became extreme. In other words, Knight had warning instruments, but no automatic emergency brake. The monitoring tool depended on humans noticing the problem, understanding its source, and responding while millions of orders were flowing through the market. Under the extraordinary volume of August 1st, even the monitoring reports became delayed and inaccurate. Technicians began trying to identify the cause, while the trading system remained connected to the market. This was the worst possible environment in which to troubleshoot complex software. Every experiment was happening live. Every wrong decision could create more trades. At one point, personnel removed the new retail liquidity program code from the 7 servers where it had been installed correctly. That did not solve the problem. It made it worse. Removing the new code allowed incoming orders on those servers to activate the same old power peg functionality that had already caused the failure on the 8th server. The defect that had begun on one machine was now being awakened elsewhere. Eventually, Knight stopped the erroneous trading. But stopping the software did not erase the positions it had already created. The company now owned and owed billions of dollars in unwanted shares. Those positions had to be sold or covered. Knight could not simply ask the market to pretend the trades had never happened. Liquidating the accidental portfolio produced a loss of approximately $460 million. That was more money than the company had earned during the entire previous year. The official financial statements later recorded a trading loss of approximately $457.6 million, plus additional professional and legal costs connected to the incident. The company's survival was suddenly uncertain. Clients and trading partners worried about whether Knight still had enough capital to operate. Only 5 days after the incident, a group of Wall Street firms provided $400 million in emergency equity financing. The rescue allowed Knight to continue normal operations, but the company that emerged was no longer in the same position it had occupied before August 1st. In December 2012, Knight agreed to combine with rival trading firm Getco. The merger was completed the following year. A company that had been worth billions had nearly lost its independence because one software deployment was not verified across 8 servers. The Securities and Exchange Commission later concluded that the disaster went far beyond a single technician or one defective function. Knight lacked adequate controls immediately before orders entered the market. It lacked automatic controls connected to firm-wide capital limits. It lacked proper written procedures for code deployment. It had left obsolete code on production systems. It had no sufficient process for responding to a major technological incident. And it had failed to learn broad lessons from earlier erroneous trading events. The SEC imposed a $12 million civil penalty and required Knight to improve its systems under independent review. But the regulatory fine was small compared with the trading loss. The real price was paid during those 45 minutes. The Knight Capital incident is often described as a software glitch. That phrase makes it sound random, brief, and almost unavoidable. It was none of those things. The old code had remained inside the live system for years. The deployment reached only 7 of 8 servers. No second person was required to verify the update. 97 warning messages arrived before the market opened. There was no automatic comparison between the orders entering SMARS and the orders leaving it. There was no effective firm-wide kill switch tied to financial exposure. And when humans attempted to fix the problem while the market remained open, one response made the failure worse. The code made the trades. But the organization created the conditions that allowed the code to continue. Automation is powerful because it removes human delay. A computer does not need time to hesitate, reconsider, or grow afraid. But when the instructions are wrong, that same advantage becomes dangerous. The system can repeat a mistake millions of times before a person has fully understood the first one. Knight Capital lost approximately $10 million per minute, not because computers were too fast, because the safeguards were too slow. The lesson reaches far beyond Wall Street. Any organization that allows software to control real money, machines, infrastructure, or human safety must assume that code will eventually fail. The question is not whether someone will make a mistake. The question is whether the system can detect that mistake, contain it, and stop before the damage becomes irreversible. On August 1st, 2012, Knight Capital had speed, it had automation, it had data. What it did not have was a reliable way to say, stop. Every powerful system has a hidden story beneath the blueprint. Subscribe for more engineering failures, expensive mistakes, and decisions that quietly changed our world.